this now. We're going to go to page 29, as I stated, and we're going to start reading what's there, okay? At the bottom of that page, it talks about Mr. James Tannen, okay? Tanson, sorry. He's a retired Army officer, opened Tannen's catering service. As his accountant, analyze the transactions listed at the present and present them in the proper form. That means you are the accountant. You're like, this is my first week of accounting. I cannot be an accountant. But it's okay. What you're going to do is you're going to analyze the transactions. You're going to go and we're going to create a balance sheet. Remember, we go back to the PowerPoint to see how we're going to do that. And we're also going to create an income statement and a statement of owner's equity and then another balance sheet. Now, one of the things that you need to realize, continuing this problem on page 30, is that you have 2 months of transactions. So we're going to go through the 2 months of transactions. Okay? So this is where we're going to be putting everything in. Notice his chart of accounts is already here. It tells us what we've got. We've got cash, we've got accounts receivable, we have equipment, accounts payable, his capital account, his withdrawn account or withdrawals, catering, and expenses. So you know that the revenue is going to be for any event that he's catering, any food, anything that he's done. Even if he just bakes a cake, that's what he's doing. So notice how in your book it has the area of October the 25th when it starts. And it just has October. So for right now, remember, accounting is analyzed month by month or day by day or quarter by quarter or year by year. So it's going to want us to create a balance sheet for October and then another one for November. Chill. We're going to go through it each time, okay? Each one. I'm going to go through this so that you can work B5 the same way, but you have something to reference, okay? And remember, the biggest thing that you guys are going to have to kind of learn is the verbiage. So, on page 30, it says October 25th. And notice we have the dates here. And again, balances. You're going to bring down every balance, even if it's a zero. So, James Tanson invested $20,000 in the catering business from his personal savings account. Invested $20,000. Which two accounts are going to be impacted? Cash and capital. So, this is positive, remember? So, how much money are we putting in there? $20,000. No, you don't have to. We'll assume that that's $20,000. Okay? Then, for the capital account, right? That's the next one. We're going to put in how much? $20,000. That's the only two accounts that are impacted. So guess what? When you come down to your balance here, you're going to have how much? $20,000. Nothing happened in accounts receivable, so guess what? That becomes a zero. Nothing in equipment. Nothing in accounts payable. Capital. Bring that balance down. He didn't withdraw any money. There was no revenue. And there was no expenses. That's for the first transaction. Okay? On the 27th, notice what it says. He bought equipment for cash from the Monroe Company for $2,300. Maybe he bought an oven. I don't know. But he bought equipment. Which two accounts are going to be impacted? And the reason is why? Because office equipment is increasing and your cash is decreasing. Okay. So we're going to go ahead and put the money on the equipment account of how much? $2,300. Watch your zeros. Okay? It's only 23, so there's only 2 zeros. And what are we taking it out of? Cash. So here, how are we going to make sure that it's a minus? You can do it 2 ways. You can either put a negative sign, or easier is to put in a parenthesis. Okay? That'll show that you're supposed to deduct that money from the cash account. So let's bring down now our new balances. So we're subtracting, and this is where you can use your phones, because they should have a calculator. If not, get a calculator. One with big numbers. So we're going to go ahead and decrease the cash account by $2,300. That means we now have a balance of what? $18,700? Does everybody agree? Some people are going to say, I don't know. Is it 18,700? 17,700. There we go. Nothing happened in accounts receivable. And this stays what? Positive, because we've increased the value of our equipment from $0 to $2,300. Are you with me so far? See? Okay. So, the next thing, on the 28th, what do? We bought additional equipment. Como le gusta. He liked that oven, he wants another one. So he decides that he's going to go ahead and buy additional equipment. Look at the verbiage. On account for $2,000. Are we taking it out of cash? No. What's happening? On account. Accounts payable, why? He still owes it on account. On account means I'm going to pay for it in the future. So 2 accounts are going to be impacted here. Which ones? And correct. Equipment. Okay? So we're going to increase equipment, debit equipment by how much? $2,000. And we're going to now also increase liability of $2,000. Right? Now, see why it's increased? It was 0 before. We didn't know anything. But now we've just increased our liability while still increasing our equipment. That can happen. That's allowed. Okay? People when they were doing this. But it works out. Okay? So we bring down our balances then. So now, what do we have as far as the balance? Did we do anything here? No, so that would be a 0. 0. On the top, right, blue, right here. Okay. And then we bring down our balance, right? Nothing happened in accounts receivable. Nobody owes us money yet. Our balance now here is how much? $4,300. We've added. Okay? Remember, because we had the balance of $2,300 before, and now we're adding more, so we have $4,300. Now, we have a balance coming down on accounts payable. Okay? So here we go. $2,000 on accounts payable. Capital remains the same. And nothing happens on this side of the equation at all. One more transaction, and this, guess what we got to do? We have to close the books for October. Okay? You're like, what? We'll get there. 29th, paid $900 to Ryan Company as partial payment on the October 28 transaction. The October 28 transaction is that we bought additional equipment. right? So we're paying this guy. We're going to give him money. Which two accounts are impacted? Cash and payables. Okay? Yes, because we're going to go ahead and pay him what? Cash of how much? $900. So here, the transaction is, well, actually, we start with the transaction of what? Accounts payable. We have to debit that. So what are we doing for, so this is